Hello, fellow Rebel Capitals. Hope you're well. Boy, sounds like I'm not well. Excuse me. Got a new office. What do you think? Let me know in the comments, in the chat right now. That's why I haven't been doing any videos. That's why we haven't been doing any whiteboard videos. We're moving into a much, much bigger office. We've got studios. We've got editing bays. We're going to be doing much more content. I'm super, super excited. But let's get right into the topic of today's video. Yield curve, guys. Yield curve. How many times have your friends and family member Freds over the past 2 years said, oh, the yield curve is dead. Oh, the yield curve is dead. Oh, you're just fear-mongering. You stupid rebel capitalist. You've just been watching that George Gammon guy too long. Just turn it on CNBC if you really want to know what's happening. And then on this channel, and others too, but in the alternative media space, let's say, we've been saying, well, this time it's probably not different. And every single time the curve has uninverted due to a bull steepener. And in the mainstream media, even on Twitter too, you're, oh, no, we're going to get a bear steepener. We're going to get a bear steepener. We're going to get a bear steepener. Why? Oh my gosh, because of the deficits, because of the U.S. debt, and the foreigners are not buying our treasuries anymore. So the long end of the curve is just going to skyrocket. We're going to see rates up to 10, 15%. And the government's not going to be able to afford to pay even the interest on the debt, let alone all the other unfunded liabilities, the Social Security, the military, yada, 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 yada. Okay, so what I want to do is focus on a clip from Jim Rickards. I was part of a panel last night with, you guys will see in a moment here, and I'd strongly suggest checking it out, with Brent Johnson, Jim Rickards, Mike Green, Emil, and Jeff Snyder, and a couple other guys. And I want you to listen to what Jim says, because then it's going to dovetail into what we're seeing right now with the 2-year Treasury yield, which, as you guys can guess, is tanking. And it's getting closer and closer and closer to that 10-year Treasury yield. In other words, an uninversion. And for those of you who watch my channel consistently, you know the stuff usually hits the fan once the curve is no longer inverted due to a bull steepener, which is the front end going down faster than the long end. But before we get there, let's check out this clip from Jim Rickards. Where'd we put it, Josh? It is right there.
We're expecting some kind of dollar crack up because of budget deficits. And I mean, the real harm of a high debt to GDP, high, 133%, highest in U.S. history, et cetera. The harm of that is not that there's a sudden repugnance in the treasury market, or treasuries collapse or interest rates go to 20% or whatever. The harm is slow growth. And Jeff, you've written about this, and I think you and I arrived at this separately, but we both said we've been in a depression since 2007. And
okay, it's also, Dr. Lacey Hunt has said it in a different way. I've been saying it for probably at least a year and a half, and I even say it a different way. So what he's talking about is the same thing that I'm talking about when I say the problem with government spending isn't necessarily the debt. Like, we don't really have a debt problem in the way most people describe it, from the standpoint of no one wanting to buy treasuries anymore. That's really not our problem. And then it's not that we can't afford to pay X, Y, and Z. And I'm not talking about that from an MMT standpoint. I'm just simply talking about that from a standpoint of the global economy, the Eurodollar system, continuing to buy treasuries, even though there's an increased supply. And the reason for that is manyfold. But first and foremost, because that represents lower growth, and you got growth and inflation expectations at long end of the curve. But even more so, what's creating that lower growth is the government spending to begin with. So the example I used just last week is, let's just say we were to wipe out the U.S. debt tomorrow. Gone. Just an alien comes down and pays it all, or something like that. Okay. Now, does that mean that the U.S. no longer has a problem? Hey, We don't have a debt problem. This is fantastic. Now we can afford to pay the interest on the debt. We can afford to pay Social Security or XYZ. That didn't solve the problem. In fact, I would argue that made the problem worse. Because here's my point. The problem is the government spending that created the debt. It isn't necessarily servicing the debt. And most people get it backwards. In fact, they don't even consider the government spending and the economic distortions it creates in the real economy, which lowers the standard of living, especially for the poor and middle class. They just strictly look at it through the lens of the bond market. As long as the bond market doesn't puke, then we don't have a problem. No. We still have a huge problem. The problem's not in the bond market. The problem is in the real economy and how the government just destroys the real economy through the misallocation of resources and the incentives that create malinvestment. So I just thought it was interesting that Rickards was highlighting that as well. So what does this have to do with the yield curve uninverting? Okay, well, what we know is that when we get this bull steepener, that's telling us that growth inflation expectations are slowing. So let's assume, like going back to the 1950s, pretty much it happens every time, that we get a hard landing or a recession. What's the government going to do? Forget the Fed. You monetize the debt. Forget that. They don't even really need the Fed. What is the government going to do? Well, I can tell you, they're probably going to do the exact same thing they did in 2020, the exact same thing they did in 2008, 2009, but more of it. Government deficit spending has become, it's basically cowbell right now. It's economic cowbell. Remember that skit on Saturday Night Live when Christopher Walken comes out? All I need is just, I need more cowbell. I just need more government spending. I need more government spending. And as the government spends more and more and more to try to fix the economy when you go into a hard landing or recession or financial crisis, that increases the percentage of government spending in relationship to GDP. In other words, if you take a pie chart of the overall economic output, the private sector shrinks and the public sector, the government, grows. So take it to an extreme. Let's say we have an economy with 100% of economic output as a result of government spending. How efficient would that economy be? What would you expect the standard of living would be? Probably pretty damn low. So my point is, forget the bond market, for heaven's sakes. That's not where the problem lies at all. It's what the government will do in response, what they've done every time in response to a quote unquote crisis, which we could be seeing the start of right now as a result of the uninversion, will create more and exacerbate the economic distortions that were created in 2020. And pretty much, I mean, you can go back as far as you want, but what really started in 2008 and then was ramped up in 2020. And I think the next time around, it will, I don't see why there's any reason to believe that it just won't get more extreme, regardless of who's in office. Doesn't matter if it's Trump, Harris, I don't care who's in office. The bottom line is they're all big government guys and gals. Okay, now let's switch up the screen share and get into the actual numbers. What is going on specifically with the 2-year and the 10-year? And what's the actual spread and how much has the 2-year gone down? That's the next question that we have to explore. Okay, we got the screen share. Let's shoot over to the 2-year Treasury. And look at this. This is a 5-day chart, guys. A 5-day chart. So on the 22nd, so what are we, Wednesday? I've been kind of out of the loop moving offices. So that was Monday. We were at 4.53 on the 2-year Treasury. Today, 4.4, down 13 basis points. This is how it happens. So now let's check out the 10-year. I've got the 30-year up. Let's check out the 10-year. Let's do a 5-day. So going back to about the same time, we're flat. We're flat on the 10-year. Right, you'll call it 4.25, 4.23. And then on the 2-year, we're down 15 basis points just in the last couple days. That is this is a classic example of an uninversion, or we're getting close, due to a bull steepener. That's the bad kind. That's where the market is predicting the Fed is going to drop rates, not because they want to, but because they have to. Not because they want to, because they're just magically creating this perfect environment where inflation is coming down without impacting the unemployment rate, without creating a recession, but because they have to, because they're responding to hard landing, crisis, recession, whatever you want to call it. Now let's get over to zero hedge and check out some things that are happening right now as we speak that could be reflected in what's happening right now over the last 5 days or so in the yield curve. Actually, before we go there, let's just go right over to the Fed and look at the spread. The spread, right now 0.15. So it's going up and up and up. Just again, it's just these cycles happen over and over. That's why it amazes me when people come out and say with so much confidence, this time it's different. And they'll even acknowledge, oh, I know that's not what we should be saying. I know it's a dangerous saying, but this time it is true. It is different. It's like, dude, maybe it's not. Maybe it's not. Maybe you're the one that's not really seeing things for what they are. And it's just the lack of humility. The lack of humility to sit there and say, well, the bond market's wrong. Okay. All right. Now let's go over to zero hedge. And look at this, guys. When was this just today? I think it might have been. The Bank of Canada cuts rates for the second consecutive month. And they said it's reasonable to expect more. Bank of Canada, yeah, this came out today, so this would have been just this morning. The Bank of Canada, which last month became the first G7 bank to launch an easing cycle, moments ago cut interest rate. And they always tell you, the central bankers, it's not going to be a cycle. Oh, this is just a one-off. This is just a safety cut. No, the economy is booming right now. I mean, the labor market is tight. The economy is on fire. We're cutting rates. This is not a rate hiking cycle. It's just like when Jerome Powell came out in 2019 in September after the repo blow up and said, this is not quantitative easing. Whatever you do not call this quantitative easing. And then 6 months later, he's running out of the burning building saying, QE infinity, QE infinity, QE infinity. And it's what always happens with these central bankers in this part of the cycle. They come out of whatever you do, don't call this a rate cutting cycle. Because if you do, you are a conspiracy theorist. If you are saying that this is a rate hiking cycle, even though we are saying it's just a safety cut, I say rate hiking, a rate cutting cycle, we are telling you it's a safety cut. If you say anything different, then basically you also must believe the moon is made out of Swiss cheese. That's the level of their gaslighting. And then the very next month, what do? They come right out and say, oh, yeah, By the way, we're going to go ahead and drop rates again, and it would be reasonable to assume we're going to drop them again next month. But whatever you do, don't call this a rate cutting cycle. It's like they cut them all the way down to zero before they actually say, yeah, the last year of rate cuts, now you can go ahead and cut that, or now you can go ahead and call that a rate cutting cycle. These guys are just, they just lie. They lie so much. But what's amazing to me is that the mainstream, or a lot of the people in the mainstream media for sure, but even in the public, they actually buy them. It's like, how many times do these people have to cry wolf before you're like, you know what? Pound sand, dude. I'm not going to buy it. And that's not even a good analogy, because in that story, the wolf actually showed up, meaning that the mainstream media actually told the truth at the end. In this case, they never tell the truth. They just keep lying and lying and lying to even greater degree and doubling down on their previous lies or propaganda, what they're trying to get you to believe. So CPI moderated 2.7 in June after increasing in May. I think they're talking about the Bank of Canada. Broad inflationary pressures are easing. The bank's preferred measure of core inflation have been below 3% for several months. And the Brett, I mean, again, so what? They're at 4.5. It's as if they're at like 20. No, 4.5 is historically low. So if you're not admitting that you've got some serious economic problems, then why are you cutting? I mean, why are we so anti-positive real rates? You say, George, well, they're cutting because they've got inflation, their core down below 3. Okay, great. Golf clap. Fantastic. So why not have positive real rates? Why is it that rates have to be negative all the time in real terms? Why not just, it's as if, positive real rates are somehow weird or atypical. No, that is a sign of a healthy economy, for heaven's sakes. Oh, geez. With the target in sight and more excess supply in the economy, the downside risks are taking on increased weight in our monetary policy deliberations. At least they're admitting there are downside risks. They said reasonable to expect further interest rate cuts. Yeah, I mean, this is the way it always works, guys. This should not surprise anybody. And if it does surprise someone, it's just they haven't paid attention to history. I'm not going to go into this article, but it's kind of pertains to what we're talking about. U.S. new home sales unexpectedly tumble in June as home buyer confidence crashes to record low. Let's check this out. Everyone's favorite. Boy, this takes me straight back to 2019 when I started the George Gammon channel. Remember these guys? Deutsche Bank plunges after jump in CRE loss reserves. They shelf plan for buyback. Should we be surprised at all that Deutsche Bank is neck deep in this CRE bust? I mean, if the very first thing, if I'm looking at downside risk in the banking system, the very first thing I'm putting on my bingo card is Deutsche Bank doing something stupid. Deutsche Bank taking way too much risk. Deutsche Bank not hedging their bets. So if I look around in the global economy and say, what's the one asset class that's really crashing right now? Commercial real estate. What's the probabilities that Deutsche Bank has a lot of this toxic garbage on their balance sheet? That would be close to 100%. I'd give that about a 99% probability. So this is definitely not shocking to the slightest degree. And it also goes back to what we've been talking about on this channel for a long, long time. And that's the probability we are in the middle innings of this banking crisis that started in 2023. It's amazing to me how many people just completely ignore what's actually happening. And every single time you say that, they call you a fearmonger. Oh, I'll sit there and say, okay, well, we're probably in the middle innings of what started in March of 2023. Oh, George, you are just absolutely ridiculous. You're obviously just mining for engagement. I'm like, no, that's actually my position. I'm not, it has nothing to do with views. I'd be saying that even if I wasn't on YouTube or wasn't doing podcasts. Oh, well, that's that. There's no way you could say that because the Fed has fixed all of our problems. I mean, George, just look at the BTFP. And what's amazing is they're saying this while every month or every other month, we have another bank that goes bust. Then another bank goes bust. Then another bank goes bust. And then you see Norinchukin almost go bust. And then you see problems with Deutsche Bank and all these things. And they completely ignore all of this data that is staring them in the face and just continue to whistle by the graveyard. And then if you even mention that there could be further issues in the banking system, then once again, you are a fearmonger. When in reality, you're just looking at the data, for heaven's sakes. You're just opening up your eyes and say, wow, there are a lot of tombstones out there. Look at them all. Look at them all. After a seemingly endless streak of stronger than expected earnings, Deutsche Bank posted its first loss in 4 years as revenue from fixed income currencies fell about 3%. All right. Also, the bank's decision to put aside a bigger loss reserve for souring loans to companies and the commercial real estate sector did not help cast a shadow over an otherwise solid quarter for several of Europe's largest lenders. So this takes me straight back to the yield curve, right? Why is it that the Fed can have rates at 5.25% and we have so much demand for the long end of the curve? And it is true, Yellen is issuing more bills than bonds, but it's not like the amount of treasuries she's issuing at the long end of the curve is somehow low, relatively speaking, because the deficits are so high. The deficits are massive, massive. So even if the percentage is higher at the front end of the curve, when you compare what is actually being issued at the long end, it would be consistent, if not higher, than what we would have seen, let's just say, in 2012, 2013, especially before the GFC. So, this argument that, well, this is the yield curve inversion is strictly caused by the Treasury and what Janet Yellen is issuing at auction. It's total nonsense. It's total nonsense, especially when you look at it through the lens of all these other negative data points, these negative metrics that you're seeing within the overall banking system. And I haven't even brought up the monetary aggregates, bank lending, M1, M2, down. The banks, if they saw opportunity out there to take risk, they'd be lending into the real economy. But instead, what are they doing in the financial system? They're buying treasuries. They're buying risk, quote unquote, risk-free assets. They're buying safety and liquidity, as Snyder would say. Right? Well, why are they doing that? Because they have this boots on the ground intel. They're dealing with corporations daily. They're dealing with multinationals. They're dealing with small and mid-sized businesses in and outside of the United States. And not only that, they're dealing with other banks. And they see the risks in the system skyrocketing. And they have for a long time, which is what the yield curve tells us. In other words, you can, as long as that yield curve is predicted, as long as that yield curve is inverted and then uninverting due to a bull steepener, the probability is very high that you still haven't seen the end of the banking crisis, because that's what the curve is sniffing out to begin with. Main takeaway, I think we're going to see more of what we're seeing from Deutsche. It wouldn't surprise me if we had another few of these mega banks actually go bust or need to be bailed out. And we'll have to continue to look at the yield curve, because if the 2-year gets down to 10, 20 basis points under the 10-year and stays there for a sustained period of time, that's when, for my portfolio, it's going to completely change. Completely change. For me, that's the paradigm shift. That's the line in the sand that I have been waiting for, to go from risk off and just kind of gold T-bill chill thing to, okay, now we need to look at what's getting cheap. We need to be patient, but we need to be prepared to go in there and take advantage of a potential opportunity from prices coming down substantially. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. See you in the next video.